Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Contrarian Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
This episode is sponsored by our friends at YCharts. Advisors, if you feel like your client conversations are falling flat, YCharts has got your back with the latest release of their Top 10 Visuals resource deck. Every quarter, YCharts updates this handy slide deck with fresh data and visuals to help advisors easily explain complex investing topics to clients and prospects. It covers everything from the value of long-term investments to illustrating how different withdrawal scenarios can impact a client's portfolio over time. My personal favorite chart is the asset class performance by year going back to 2013. Click the link in the show notes to get your copy of YChart's go-to client communication aid to level up your conversations, actively engage clients, and educate them about their financial goals. And if you somehow haven't signed up yet, new YCharts users can get 20% off your initial YCharts professional subscription when you start your free YCharts trial and tell them I sent you, new customers only.
Happy summertime, everybody. We got an awesome show today. Our returning guest is BlackRock's Kate Moore. Kate's a member of the Global Allocation investment team and head of Thematic Strategy. Kate, welcome back to the show.
Yeah, thanks, Meb. Great to be here. Happy summer.
We find you back in the mountains.
That's right. Returned to the mountains after a long stretch in New York. And I'm going to be very excited, actually, to get some fresh air and some hiking in.
We last chatted with you Feb 23, so a little over a year and a half ago. One of the favorite questions we ask our guests near the end is a view you hold that's non-consensus, that most, vast majority, 75% of your peers would disagree with. And you said at the time, the U.S. economy is going to adjust to higher rates without getting anywhere close to a recession. Don't bet against U.S. corporate dynamism. You were right, or it sounds like you were right. Walk us through what's been going on the last year and a half, and if people come around to Kate's view?
I feel pretty good about that call, actually, and still feel pretty good about the call about not imminently entering a recession. I think one of the problems people have is they look at all this economic data that's often kind of backward looking, or they'll look at surveys that are not really that broad, and they'll make an assessment of the economy. And I think the real key to getting the economy right is marrying all of that macro data with everything that companies are telling us. And whenever you have this kind of disconnect where like the economic data looks just okay, but companies are saying, hey, my business looks pretty good and I expect to spend more in the future and here's my area of investment, you say like, okay, well, that disconnect between what the economists are saying and what companies are saying was a real investing and trading opportunity. So we've been pretty constructive on the economy throughout 23. That was a good call. And going into 2024, even though we start to see some fractures forming throughout the spring, and people are getting a little bit more worried about activity in the back half of the year. It's not keeping me up at night, Med, but I am conscious that the economy is running on multiple different speeds, and it's pretty hard to craft policy around that.
What do we look like today? What's the macro equity investor perspective here in summertime 24? What's the world look like to you?
Well, we've come in kind of hot to the summer of 24 here, right? Where we've had exceptionally strong equity returns, not just over the last 6 months, but really over the last 9 to 10 months. There's been a lot of concentration in terms of the equity market leadership. We know that. I'm sure we'll talk about market breadth at some point. And there has been a lot of concern, particularly around the fractures in the consumer. Thinking about how the market reacted or what the discussion and the sort of zeitgeist was as companies reported first quarter earnings. There was a few companies that talked about the low-end consumer showing cracks or people trading down in terms of their purchases and spending. And people wanted to extrapolate that to the entire economy without recognizing that certain segments were more challenged than others. And by the way, it turned out not just the segment, but it was certain categories of spend were challenged more than others. Right now, we're seeing that continue, even as the overall economy looks pretty strong. And of course, the labor market looks really healthy. Chair Powell and all the Fed speakers have been going on about how the labor market's adjusting appropriately. And we've had a lot of people discuss sort of like the slowdown in hiring. I just remind everyone, we added another 200,000 jobs when we're at or close to full employment last month. It doesn't feel like a huge slowdown. It feels like a very firm labor market at a time when prices are starting to ease and disinflationary pressures look pretty positive. So I feel good about the economy right now, even though it is once again coming into vogue to talk about where the weakness is.
It seems like the expectation now is that the Fed is pricing in a cut this fall. Is that your view? And how important is it that we get some easing here in the back half of 24?
We are in the September seems likely camp as the first cut. But even more than whether or not we get two cuts in 24, the thing I'm really sort of wrestling with is like, what is the path of this rate easing cycle look like? Is it going to be 200 basis points or just 100 basis points? If the Fed doesn't feel confident that they can continue to move, let's say at a 25 basis point clip for a bunch of meetings in a row, it doesn't make a ton of sense. It's not going to really move the needle. And a somewhat controversial opinion, or something that people don't love to talk about, is the fact that there are segments of the economy, both large companies and wealthier consumers, that are really benefiting from this higher rate environment. So let me just say something about the large companies. I mean, I think we all know that they are much less sensitive to interest rates than they have been in the past. They've locked in low rates, they've termed out their debt, their effective interest cost is like very low. But they also are sitting on high cash balances. And these high cash balances, if they're not deploying that capital right away on CapEx or M&A or spending on R&D or increasing wages for their workers, is like earning them money. This is not an environment a lot of people have lived through, or at least a lot of people on Wall Street. You have to have been around for a little bit longer. So these large companies continue to do well in a high rate environment, and higher end consumers, let's say the top 40%, the top two quintiles of earners, are also in that same situation where they're asset owners, asset prices have been going up, they have investment accounts are going up, and they have cash. And that cash is earning between 4 and 5% just sitting in a money market fund right now with no risk. So perversely, this higher rate environment is actually making big segments of the economy on the corporate and consumer side wealthy.
That 5% rate of return on the balance sheet is no longer trivial. That's a big delta from zero a couple years ago. You already alluded to, so let's go there, the concentration. And I feel like this is probably well discussed in the media. Like, people realize that you have some concentration of some of these big names, NVIDIA really being the poster child for this. But what's your thoughts on the market? Are we seeing any breath signs, positive or negative?
Yeah, so just to kind of level set here, the equal weighted S&P is up less than 4% at this moment in time, and the S&P is up close to 18%. So that's a huge spread, and it's a spread that people have been saying has to reverse. But let's go back to the start of this year, because there were great calls at the beginning of, not great from a being correct perspective, but a great number of calls at the beginning of 24 for rotation out of the mega cap leaders and into laggard sectors and stocks. And I was like sitting there going, like, where are people getting this idea? You have to bet on fundamentals. And if smaller companies who are maybe more interest sensitive or who are at a place in the supply chain where they don't really have pricing power themselves, or sectors that are either constrained by inflation, constrained by rates, or are not seeing a huge amount of revenue growth. Like, we don't just rotate into them for the sake of rotating, but people, especially the sell side, was like trying to make a call and trying to get people to do something new. I feel less stressed about the leadership in 2024 and the concentration, because those companies that are leading from a price performance are also leading from a fundamental perspective. These are companies that are putting up big revenue numbers, also delivering on the bottom line in terms of earnings. They are companies that have huge amounts of free cash generation. And even more importantly, most of these companies are less economically sensitive. Again, I don't think the economy is going away, but we're kind of in secular spending and secular investment environments for huge parts of tech and tech adjacent industries. So the companies that are winning are strong companies. These are not just a whole bunch of crowded trades where you've seen speculative action. I guess that means I'm a little bit less stressed about leadership in 24.
You have the pulse a little bit on earnings and what these companies are conveying. Is Q2 any insights you can pass along for where we are here?
Yeah, I've got a bunch of thoughts on second quarter earnings in general. And then I'll talk a little bit at some point around a tech trip, just a whole bunch of BlackRock investors just did, where we kind of really dug into the base and the growth cases for a bunch of these companies that are leading. So let's talk about second quarter earnings because we're just here on the cusp of reporting. And kind of the baseline is consensus is around 7 to 8% EPS growth for the second quarter. That's an acceleration from the first quarter, so pretty good news there. And I think one of the things that makes me constructive on earnings season is that number one, we have had very few negative pre-announcements going into this earnings season. Oftentimes companies want to get out the dirty laundry right away. They come out, they just want to puke it out. That's not happened at all. In fact, there's been these very few negative pre-announcements and actually some really positive pre-announcements. And that's an improvement over recent quarters. I think if there was really bad news to be had, companies would have shared some of it ahead of time. The second thing that leaves me constructive for overall earnings season is I pay very close attention to earnings revision ratios. And for all of you guys that are not in the weeds on this, earnings revision ratios are just the number of upgrades to the number of downgrades. You kind of calculate it by a diffusion index. It doesn't tell you the magnitude of the upgrades versus downgrades, but it gives you a sense for overall direction. Are people more constructive on the earnings? Are they coming less? And earnings revision ratios actually around the world, not just for the US, have been quite strong, not just over the trailing 3 months, but over the 1 month as we go into earnings season. In no place is that more present than in technology, where earnings sentiment has continued to improve going into reporting. In fact, the 1 month earnings revision ratio for technology stocks is over 2. That means more than 2 upgrades for every downgrade. That is actually pretty unusual. And let's be super clear, that is not sustainable over the long term. But it does tell you that all of the good news may not already be priced in from an earnings perspective if we continue to see these analysts upgrading.
How much of this is isolated to the really big firms? Are you seeing this in sort of some of the mid and small caps too? And the reason I ask is if you look at percentage of stocks outperforming the S&P this year, it's one of the lowest you can come across. And you mentioned equal weight still in positive territory. I think small caps are down on the year still. And so as we think about kind of the mid and small, are they performing well on the corporate level, but the stocks are lagging, or they just not look as shiny on the kind of earnings side too? How far do you guys go down in the cap structure? I know you guys got a lot more commas in your AUM, so you're probably not dipping into these tiny companies, but mid caps maybe?
Yeah, I do invest in mid caps, sometimes in the Global Allocation Fund, which I help to manage. We have to do it, and sometimes baskets because our fund is sort of large. But I do pay very close attention to small caps, and thanks for calling me out on that, Meb, because it's true. It's a really different story from both an earnings and a price performance perspective. Small caps were another place that the street really wanted to get excited about going into 2024, especially because there were these nascent signs, or at least nascent to the people who were recessionistas in 2023, these signs that perhaps the economy was in better footing than they had expected. Okay, fine. So maybe that's a rotation into small caps, but they were ignoring some very big and important things. I mentioned before the debt profile for large cap companies. Well, the debt profile for small cap companies could not look more different. Not only is a significant portion floating rate, but a lot of that is bank loans. And those bank loans have become scarcer in supply. So we're not just talking about policy rates plus. It is also whether or not banks feel like lending money to these smaller companies. So that's one consideration. Another big challenge with the small companies is they tend to be more single industry or single business players. They tend to be less diversified. And that may be great if you're trying to isolate a specific idea, but it's much more challenging when you're talking about a multi-speed US and global economy where a big diversified multinational is going to have many engines running and engines running at different speeds. So they tend to smooth the cycle a little bit more. And then I think critically, these smaller companies generally are less profitable. So I talked about how the large companies have these cash balances that are really helpful for them. The small companies don't. And the big thing that makes me feel that large is going to continue to outperform small MEB is that the large companies are investing very heavily in software systems and technology to improve their efficiency and productivity. And we see this from a whole bunch of surveys. One I like to highlight is a series of questions coming out of the Richmond Fed CFO survey. They ask all these CFOs across public and private companies, are you spending on technology? What does it look like? And there is it's a tale of two cities when it comes to small and large. All these large companies have been putting huge amounts of money to work, and small companies have been stalling on that strategy. Longer term, I think that's going to be a really significant challenge for their profitability and their competitiveness. Maybe that means we'll see more takeouts and M&A, but in the near term, the fundamentals from a rates perspective, from a business perspective, and I think from a technology investment perspective, just don't look great for the small caps on the whole.
Another point too is on average, much higher percentage of small caps are unprofitable. These companies don't make money versus the large ones, which is one of the reasons they're small caps, of course, because you get a lot of biotech and other stuff in there. But just to put a performance pin on this, and this can obviously change very quickly, but I did a tweet this week where saying 2024 is on pace to eclipse the record for single year S&P outperformance over equal weight. And that 1998 was the current record, but that only goes back to the 1970s. But if you use small cap as a proxy for sort of looking like equal weight, basically the giant versus breaking the market cap, you can take that back 100 years. And 98 was the winner there too. S&P outperformed small caps by 26%. 2024 currently would be right around number 3 after 1929. But again, this is only 6 months in, so who knows what's going to happen the rest of the year. As always, will be fun to watch. You see people on Twitter and sentiment. I know you love to look at sentiment, talking about inflation, and somebody was losing their mind over a $25 Five Guys burgers, fries, and drink meal online. Is that having any effects on either end, low end, high end, in between, neither?
Yeah. So the one thing that every consumer segment loves to complain about, and you just tapped into this, is food prices. And food prices, because it is often our most frequent purchase, is food. Food at home, food away from home. And we're really conscious. Although my big gripe is the car wash in town here raised their prices by 20% and no longer offers wash booklets. So, and everyone's just paying it because our cars get dirty in the mountains. But on the food side, I think this is really important because it plays a disproportionate role in consumer sentiment. And that matters even more than normal because this is an election year. So there have been lots and lots of surveys about feelings around the economy. And we've seen all these essays, given how strong the labor market is, given how strong job growth has been and wages are keeping up with inflation at this point, in some cases exceeding. So we're getting real income growth. Why does everyone feel so terrible? And when you boil it down, most people feel terrible because of their high frequency household purchases, disproportionately food. And I was having this conversation with an economist friend of mine, and I said to him, why don't they see that there has been disinflationary trends across all of these food segments? And he said, Kate, we need to get out of our own way. We think on a year-over-year basis, prices are not growing at the same rate that they did in the summer of 23 or in the peaky area of 22. But everyone's benchmarking against the last low price they remember, which might be pre-pandemic. And this is really interesting. And I had to really reframe my thinking about this, which is it's not the path that prices for food have been on more recently. It is the sort of starting point for prices today relative to where they were 4 or 5 years ago, maybe. And that's leading to a sentiment drag. And I think it's very popular to point out these increases in food away from home, for example. One thing I will say, and there was some interesting data that a bunch of political surveys put out in the middle of spring. And effectively, what they showed is the people who feel least positive around the economy were by and large women. And this is regardless of their political affiliation, whether they identified as Republicans or Democrats or independents. When you break down the segment, it was largely women. And women make up to 3/4, sometimes 80% of household purchases, and perhaps are even more sensitive to the changes in food prices. And that's having an impact on how they see the overall economy, even if many other things are going well. So I'm watching how people talk about food prices going into the election, because I think that will be a factor in how they vote, not just at the presidential level, but down ballot.
There's two things that I think you mentioned that are really interesting. The one is all the investment world thinks in rate of change. All right, inflation's 3%. That's not bad, right? It's historical. However, what you mentioned is if you had a couple years, just hypothetically, say if it was at 10%, just because we're back down at 3, it doesn't go back to where it was, right? Listeners, like if you think 10%, 10%, you have this plateau now, like you've gone up a bunch from where it was. And even though the rate of change is slowed, you're still much higher. And so there was a tweet that became pretty viral where it was a man who tried to reorder some groceries from 3 years ago. It was like the same basket. And then he measured how much the price went up. And of course, the reveal is a lot. So this is a to-do list, listeners. We'll try this for this episode when it comes out. Go find your Instacart or I don't know what, Amazon, probably not great for groceries, but curious to see if you could reorder the same basket, what the prices would be.
But this is like recency bias too, we have to think about. So our sentiment is most impacted by our most recent experience instead of sort of the collective experience. And the recent experience today, when we think about interest rates, just like straight interest rates, is like, wow, they're high. But relative to my nearly 5-decade-long life, they're not that high. And prices for loans and prices for mortgages are not that outrageous in the grand scheme of things. But all we remember is we had a decade or more of almost 0% rates and free money. And today it costs more. And so there's a lot of angst around that instead of putting things in a broader historical context.
I love the financial history books. And one in particular that we talk a lot about was called The Great Depression: A Diary, which is fun because that's a totally different environment than all of us have grown up in. Even our grandparents at this point are probably aging out of that experience. And so you walk through some of the thoughts and how people thought about it in real time is fascinating. So even same thing, like most of the younger crowd wasn't around in the 70s. I wasn't. So you kind of got to learn by osmosis and reading about it rather than your own personal experience. And I think that's also why travel is so great, and talking to people from other countries who have experienced things like hyperinflation or other things like bear markets. We got 15 years of romping and stomping, but you go chat with friends in Latin America and Asia and other places, they have a little different perspective than what you may have. And then not only across time and across geography.
That's right. I'd say my emerging market investor friends, and I started my career being an emerging markets investor, maybe the first 10 years or so, they all like to say, it's about time the rest of you woke up to the dynamics that we've become used to. Higher inflation, policy that's not perfectly predictable and forecast years in advance, in some cases like political turmoil, and significant changes in the volatility of a market. So everyone just get back to normal. EM's been living it while DM has not been.
We're bouncing around a little bit, but that's the nature of my conversations. And you mentioned a couple great tidbits as we're going back and forth. So we're going to zigzag a little bit. EM, you mentioned one of the trends with the U.S. market cap weight creaming everything. It's not just creaming mid and small cap. Historically, over the last 15 years, it's been creaming foreign and emerging, if that's even something anyone talks about anymore. One of my favorite topics to talk about, though. And so you've been racking up any frequent flyer miles, traveling around the world anymore, looking at EM, or do you keep a pulse on it? And if so, your old friends in that world, any conversations about how things are doing there? I know it's so dominated by China, but you see India be ascendant. They're having kind of a romping, stomping bull market. What are your thoughts?
Yeah, India is having a great run. And actually, India is a place we are really constructive on. To the extent I've been romping and stomping, it's been to India of late. meeting with both companies and policymakers. One of the challenges we have with the Indian market is that you don't have the depth and liquidity that you have, say, in a European market, but the potential is almost to the moon, both in terms of the consumer side. There's a huge amount of technology investment. We see an enormous amount of potential growth there. So while the number of companies that we may be invested in may not be the largest, it is a place that we're putting more resources from like a headcount perspective, as well as a mind share perspective. And I expect India to be a significantly larger part of our portfolio over the next couple of years. Outside of that, there are lots of places in Asia, ex-China, that have interesting companies that are geared to the AI and technology supply chain that we really want to continue to add to our portfolio. So I would say it's like stuff across the semiconductor sector. It's stuff within software. There are companies in Japan, for example, not EM, but Asia, that are very advanced in industrial automation, which we see as being a strong secular theme for the balance of the next couple of years, tied quite closely to that deglobalization and change in supply chain and trying to increase efficiency and productivity themes. So there's a lot to do outside of the US, but I think you have to be more stock specific and theme specific rather than just buying a broad market. It's also worth noting that's how I feel about Europe, which is there are some great companies. They're also very well owned and trade at a huge premium to the rest of the market, but you have to be selective. So instead of just answering EMF, I just kind of went around the world for you, but hopefully that gives you a sense for how we're approaching it.
You have probably the first slide deck I've ever seen that references Ender's Game, which is an awesome book. I haven't seen the movie because it kind of got some rough reviews, but maybe we'll queue it up. Incredible book. What were you talking about? Do you even remember? I think it was about AI, tech, swarms, swallows, birds.
Well, first, I'm like an obsessive sci-fi reader and have been for a couple decades now. So I've read Ender's Game a couple times. I also did not see the movie. I find most of these movies really disappointing. Like, also, I would put this in the category of Three Body Problem. That is like an outstanding book. I hear the series is pretty good, but I just can't do it because I already have a vision of what that should be like. Have you read Three Body Problem?
Well, there's two. There's a Chinese series and an American series. And we watched a couple of the American and it was tough, honestly. But apparently the Chinese one is better. But I'm with you. It was a little harder book than Ender's Game. Ender's is a lot easier to read than Three Body Problem.
A little less physics.
Yeah. But Dune 2, I thought was pretty spectacular to watch on the big screen.
I agree. I'd say these new Dunes are coming out pretty well. A little bit dark, just exactly as the book should be. The reference in there to Ender's Game was around the hive mind, which people are afraid of, right? This idea of everyone having a kind of a group think, and there's one stream that pervades everyone's thoughts. But I think there's real benefit into getting people together and what I'm calling sort of swarming a research project. Now, we see programmers do this kind of stuff all the time. They will take a whole bunch of different programming teams and redirect their energies to a project that may not be core to their day work in order for them to get a fresh perspective, in order to supplement and check code and things like that, and then they can kind of go back. One of the challenges I'm seeing in the investment business in general is that people get really siloed, they stick in their lane, and they don't tend to think in the cross section. So I'm trying to encourage the team to do things a little bit differently. When we see a really interesting problem or idea, something that might span a couple different sectors or geographies or may not just sit in one person's sphere of expertise, to bring people together to kind of swarm on the idea. Well, let me just give you an example. So there are companies that have a couple different business lines. You might have a company that has both a software and a semis exposure. And then one analyst is like, well, I'm a semis person, but it's not a pure play. Or the software person says, I'm a software person, but it's not a pure play. Both of those people should look at the company, as well as, say, a person who always looks at industrials, for example, because they may have a fresh perspective. So much of the baseline common knowledge is now available to us through AI tools. We can get it so quickly that the value is in how do you think strategically? What questions do you ask? How do you challenge core assumptions in that business? And so bringing people from outside of their lanes to approach and dissect and really diligence a new idea, I think is super valuable. It is not trying to get us all in the same space at the same time, but take our diversity of our approaches and our thoughts to really attack a problem. And the more that we leverage AI tools for the baseline knowledge, the more that we can create people who can think in the cross section. And those are the people I think who are going to survive in our business.
Easy to say, and I feel like that's attractive for all of us. And then yet when we go on Twitter or we want to research a stock that we own or a team that we like, you're looking for confirming evidence. I'm not reading articles hoping to find out why the Broncos are going to be bad this year. Or if I own mega cap US stocks, most people don't spend their time doing that. Do you have any suggestions like how to do that, how to get out of our comfort level? Because it's harder and awkward and not as much fun. Any suggestions?
I would say not only do people find it awkward, but they're afraid if they do that, they'll have a harder time demonstrating value. And it'll be harder to kind of link their contribution. And everyone, of course, wants to say, me, this is what I did. This is how you should pay me. So here's what I do. And this is an exercise I ask people that work with me to do. Write down all of your priors. Let's get all your biases out. I can talk about some of mine. I know that I have a bias against small caps, and some of it's justified, but I have to keep on revisiting why I have that bias. Or I have a bias to be concerned about market breadth in parts of emerging markets that are very concentrated in resources and banks, and so all these sorts of things. But write down what are all your baseline go-to structural thoughts. And then you have to, if you're going to be intellectually honest and you want to continue to grow, you want to be a strategic thinker, and you want to continue to be relevant, you need to really challenge each of those on a regular basis. I have some pretty strong thoughts, maybe around parts of politics or policy. And like, if I go out of my way to read commentators and thinkers who see the world differently than I do and try to engage them in conversation. And it's really important because you don't know where your weak spots are until you start to have these conversations. So I think owning what you know, owning what your bias is, and then making a deliberate plan to at least try and challenge some of those biases is how you get to be a strategic thinker.
My number one quote, non-market related over the last 2 years, and sorry, podcast listeners, because you've heard it a few times, from Adam Grant, where he says, the hallmark of an open mind is refusing to let your ideas become your identity. And I think it's true with markets too, because so many folks, they're a dividend guy or hey, I'm a mining gal. I love natural resources, whatever it may be. And you get attached to these asset classes, you get attached to the investments. And I think it's hard.
So I love Adam Grant, and I feel like I screenshot most of his posts to save them into my little archive. But I also love Simon Sinek. He's a great thinker, and maybe I'll share with you some stuff afterwards. He does some great talks. And anyway, he has this quote, and I have a post-it of it up on my monitor, and it says, play it safe and you'll always end up with mediocrity. And that's what I think about this in terms of being flexible about the way you approach an investment idea or your framework, which is if we play it safe and just stay in our lanes all the time, then we're going to come up with maybe just the best idea in the small pool of things that we look at. And that may not be the pool we should be playing in at all. I also want to encourage analysts to sort of say, hey, maybe I've been covering consumer staples for my whole life, and I know all of these companies inside out, but are those companies going to really generate the returns, the cash flow, and grow the way that some of the AI and tech adjacent stuff will grow? I don't think so. Don't just play it safe because that's what you know. You're going to end up with mediocrity, like a mediocre portfolio of companies that are not growing, but maybe the best in that small pool that you're fishing in. So challenge yourself.
Yeah, we'll add some Simon's TED Talks and stuff to the show notes, listeners. So go check those out.
Yeah, he's great.
What else is on your brain? What are you thinking about? Anything in particular?
There are a couple things that I am nervous about, and I'm sort of watching. Number one is, and I don't have a specific catalyst for it in the near term, and it's frankly not my baseline at all, a really sharp momentum reversal would be pretty painful at this point. So I'm keeping my eyes peeled, as it were, for what some of the risks, whether it's geopolitical or disappointments when it comes to earnings as companies are reporting second quarter, bad news and talking about taking down their forward guidance, anything that could shake confidence a little bit and lead to a momentum reversal, because I think that would be a significant pain trade, not just for us, me particularly, but for big parts of the market. You could see fast money de-risking very fast, even faster than normal in that environment. In general terms, you say like, okay, a 5 to 8% pullback is not so bad. We haven't had anything like that since late 2023, but we have to be conscious of what might cause that. And look, volatility is really low. It stayed really low. Volatility out into the third quarter, into fourth quarter still looks really low. So I'm watching that really closely. That's kind of one of the things that keeps me up at night. Like, what could be hiding in the corners that I'm missing that could lead to a momentum unwind, even if that's not my base case.
Yeah, as a trend follower, I'm always in agreement with you there. And it seems like a lot of the traditional, at least with like the fixed income world, which we haven't talked much about, a lot of the spreads are pretty tight too. And it's not like that you have these giant spreads that may compensate for some of these markets. It seems like they're pretty slim. This is an odd question, so you're going to have to put on your toque, your thinking cap, as you're walking around Jenny Lake. Let's say you and Rick Reeder are cruising around the lake, chatting about markets. What do you guys disagree about? Is there anything in particular if you guys are chatting, or if there's anything non-consensus that you're chatting with your team that Kate's thinking about?
Well, I think one of the debates we have, we touched on a little bit earlier, which is crowdedness in the market. And you mentioned earlier, I pay a ton of attention to sentiment and technicals. That's a big part of my process, not just in timing entry and exit points, but in thinking about how to size different opportunities. And so you look at some of the mega cap names and in particular, the AI related names, and they do feel fairly well owned. And yet my baseline expectation, given all the meetings I just had with them the week before last, is that the news is still going to be good for some time in terms of revenue growth, broadening of customers. Rick does worry sometimes about things getting a little crowded. And so that is an area we constantly talk about. I think another area is, I think there's going to be this is maybe not something Rick and I disagree on, but this is an area that I'm kind of focused on that I would talk to him about. I think there's going to be great opportunity to really pick winners and losers as we get more firm use cases and work streams out of AI for all these different industries. Yeah, so this is not a disagreement, but trying to figure out which are the names that get us there. Because I mentioned before that large companies are spending more on the technology, on the software, on things that enhance productivity, things that increase their efficiency, also that reduce their overall headcounts. I mean, that's a big one. And that's going to be low-hanging fruit. But those companies that really own or really have control of unique and proprietary data sources are going to move head and shoulders above their competition and their peer group. And the ones who figure out how to handle and use AI tools with those data sources are going to be in a completely different universe. So we think a lot about, and we kind of talk a lot about, how do we think about concentration risk? Do we want to lean into these companies even more than we do? When will they really pull away in a meaningful way? What does that mean for consolidation industry and for M&A and capital market activity? That's another area we talk a lot about. So those are some of the things. But Rick and I also share a massive love for golf. I'm sure we would be talking about that as well.
Well, I'll hit you up for some tips later because I'm terrible. On the AI side, I haven't implemented it a ton in my personal life. It's been more of a curiosity. We've played around a lot with the content world, the LMMs, but our producer, Colby, implemented, there's a company called Podcast AI, which listeners, if you're a podcast host, go check it out, because tell them Meb sent you. Maybe they'll send you a hat. But he's like, we implemented this and it cut our costs by some ginormous amount. And also it just did 80% of things that we were doing before that were manual and headache producing. So I imagine that's a very small microcosm of what everyone else at corporate America is experiencing. As you were talking about some of the concentration, one of the things I was noodling this past week, I was chatting with someone, and people would love to talk about the Qs, and they talk about NASDAQ as a tech fund, as the Qs being a tech fund. And I said, well, hold on. Like, if you actually understand the methodology of how the Qs invest, like, it's not a tech fund. And if you actually ask most people who probably invest in the Qs, or even financial advisors, what the Qs are, I think they would probably get it wrong, because you have a handful of stocks in there that aren't tech stocks, like Costco, which you mentioned is a top 10 holding of the Qs. And I was noodling the other day, and I haven't spent any time researching it, but it's on my to-do list of trying to isolate all the stocks that are in the Qs that aren't tech, and see how much like the flows are kind of dragging them along in some of this market concentrated flow exposure, to where is Costco and Pepsi and some of these other companies that are not traditional tech companies, are the flows pushing them to an area they're not normally, not supposed to be, but just not normally would be associated with. They're getting kind of spillover. I don't know. I don't have any conclusion. It's more of a things that make you go,
Well, I did something, I want to respond to something you said in the beginning, which is about how you're using tech tools and AI tools in your personal life. So I'm not sure if you have used Perplexity. So I've got Perplexity on everything now. And I will tell you, I had a little problem with my dog the other day. She ingested something she shouldn't have. Golden retrievers. What are you going to do? And so my best friend is a veterinarian. And so on the phone with her, I asked her a bunch of questions. She's been a practicing vet for 25 years. And I tested Perplexity for answers. And I was getting almost I'm going to go with everything that Emmy says, but almost everything versus what I was getting from some of the other AI tools, which was like a little bit more hodgepodge and kind of mixed up. I've gotten to a point where I can do baseline research on something so fast. I mean, I'll be in corporate meetings where I may not be like super in depth on that company and I don't know a ton, and they'll use a phrase. And instead of looking like an idiot, I just plug that in as I'm taking notes on my iPad, and boom, I immediately understand and can connect the dots. Can you imagine 10 years ago, the Google search wouldn't get me what I needed. 15 years ago, when I started my career, I think the path of understanding and of learning is changed so dramatically. And for what it's worth, I think that's going to mean that eventually we need less people in some of these basic research roles, because goes back to that swarm idea and thinking in the cross section and challenging yourself outside of your lane, because we're going to be able to get that baseline information so much faster.
It's exciting. I'm looking forward to it. I was on the flight back from Japan. I was using Perplexity as an experiment where I'm trying to write like a little coffee table book that if you look at the long-term return of US stocks, right, that famous chart and all the crisis events that have happened, I'm trying to write a little coffee table book where it goes back to 1900, shows the crisis event of the year globally, and then how the global stock market did over the next 1, 5, 10 years, whatever, 20 years, demonstrating, hey, even though Pearl Harbor happened, Boxer Rebellion happened, whatever it was, you still ended up in a good place by investing. But I was like, you know what? I really don't want to write this book because it's a lot of work. Like, I don't know anything about the Boxer Rebellion. I don't know anything about this dam collapsing and Spanish flu. But I'm like, Perplexity does. So like within an hour, I got the prompt dialed in and I wrote 10 chapters. Well, it wrote 10 chapters in like an hour. And I was like, oh, this is really going to be a lot of fun and interesting. So we need a name for the book, listeners. If you got a good name, hit me up. Right now we got Crisis Investing, which doesn't sound that good. Stocks for the Long Run's already taken. So if you guys have any good titles, hit me up. I'll send you a free hat. But yeah, also listeners, if you have any particularly wonderful AI suggestions on how to implement some of this stuff, you can either leave them on the YouTube comments or send them to me. I'm curious to hear. Kate, what else? You mentioned you're an avid reader. What's on your bookshelf right now? Anything good and particularly wonderful?
Well, I'm reading a series that falls more into the fantasy than sci-fi category at this moment. And that series is about kind of a riff on Middle Eastern mythology. And I have to say, it's super fascinating. There's nothing better than like after spending an entire day staring at screens and looking at numbers than to get really, really deep into this stuff. The author is this woman, S.A. Chakraborty. The first story is City of Brass, and the second is Kingdom of Copper.
It's a short stories book, or it's a
Unfortunately,
series?
these are like 800 pages each. But it's kind of like an epic, but it brings in a lot of this Middle Eastern mythology, which, is a new genre for me. Anyway, I'm loving that. And I just finished Peter Attia's Outlive, which was incredibly impactful for me. I had some pretty bad health issues last year with breast cancer, and I've been thinking a lot about how I want to live the second half of my life. And I've always been an athlete, but there's so much more I can and should be doing in order to live the best and most athletic version of Kate's life for the next 40, 50 years.
Deadlifts, right? What else does he say? Deadlifts, that's a big one.
Definitely doing all of the weightlift and training stuff, which was kind of in my scope. But I think one of the things that I love that he talks about is the importance of community and the importance of connection and the emotional well-being and how critical that is for all of the parts of your physical well-being as well. So it's kind of a call to action, spend even more time with my friends.
Well, you got the lifestyle dialed in. Being in Jackson Hole in the summertime, magical place. Get to head down to the Mangy Moose and spend some time with some friends. That sounds like a nice summertime. Kate, it's been a blessing. Thanks so much for joining us today.
Yeah, thanks so much for having me, Meb, and hope you get out and enjoy some fresh air this summer as well.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.